Hi, my name is Lawrence. I'm the author of Financial Freedom Through Property. One of the questions I get a lot from my students is it better to invest in a new build or in a property that's been already built many years ago? An example like a CBD kind of area. So in this short series, I'll be analyzing several new builds and just showing why investing in new builds can be risky and can be difficult. If you haven't already, please subscribe, click the notification button, join this tribe. I'll be sharing, as I always do, weekly updates and weekly videos, so make sure that you don't miss out on everything property related in the South African market. Welcome back to another episode of the series of the New Build Dilemma. Now, new builds is a very attractive way for people to get started in property investing because you're buying something that's shiny, that's new, that doesn't require any maintenance. And new build developers and marketing teams for these companies are very good at painting the picture of a new build being a very good, sound financial investment. In this series, we're going to unpack whether it's better to invest in a buy-to-let or into a new build. And the answer, quite simply, is it depends on your strategy, right? Both have pros and both have cons. If you look at your lower income sort of CBD market approach, you're buying properties for 2, 3, 400,000. You're renting for 6, 7, 8,000. You've got more than enough yield to be able to earn a cash flow, a profit at the end of the month. Right, so your income is higher than your expenses, leaving you with a positive cash flow on a month-to-month basis. That's what's great about that sort of lower income market. If you're looking at new builds, the strategy is not cash flow, the strategy is capital appreciation. From a cash flow perspective, 9 times out of 10, the income is going to be insufficient to cover the expenses, leaving you with a negative cash flow in the new build strategy. Right, at least for the first couple of years, let's call it 4 to 6 to 10 years maybe. Now, where the capital appreciation strategy lacks the cash flow, it is strong in the sense that there's a likelihood or a potential for the property to appreciate in value. If you look at your cash flow strategy, the appreciation is going to be minimal, if any. If you're going to see a 3 or 4% capital appreciation rate, that would be probably quite high. Versus your new builds have the potential to appreciate a lot more. Now, I use the word potential and speculation very carefully here because it is a gambling strategy. As much as a developer will tell you that the property is going to appreciate by 8 or 10%, or an estate agent might say that to try and convince you to make a buying decision, the reality is no one knows. And for me, that's why I've chosen the cash flow strategy and avoided the new build strategy, because I don't believe in that methodology. Right, the cash flow strategy, it's about income being greater than expenses. You can predict it, you can plan for it, you get that passive annuity income. The new build strategy works well if you're happy to lose money on a month-to-month basis, but you believe enough in the area that it will appreciate over time. So let's jump into a live example, and I'll take you through how I see a new build investment. Today we're looking at iGrow, another one of their developments in Benoni. As always, I am not affiliated with iGrow or with any of these other development companies. I'm not paid to make positive or negative comments or to trash talk any of them. I'm merely just sharing my opinion as an investor, as an active investor, how I would look at these deals and what I make of them. So yeah, I hope no offense is taken. So this is the Angelwood investment opportunity in Benoni. So it looks really nice. Let's see here. Okay, so selling from 795. No levies for the year 1. Okay, so that's very common. We've seen that numerous times now. So it might be that cash flow is positive in month 1 or in year 1, but what about year 2 when the levies actually come on play? So it's a marketing activity or marketing trick. So just make sure that you're working out your cash flow for year 2, 3, and 4. All bond and transfer fees are included. Okay, cool. 100% financing available. That's quite interesting. And 20,000 rental assist. So again, the tendency to make sure that year 1 is positive by giving you a 20,000 Rand rental assist. But then what about year 2, 3, etc.? Okay, so 2-bedroom, 2-bathroom in a great location. Let's see if they have any other numbers here. Projected rental income of 7.2. So gross yield of 11.5. 11.5 is not bad. That's actually pretty decent for a development, but it's still under the 15% that we need for it to be really cash flow attractive. I'll often watch these videos, these promos, because it often gives you a sense of what's happening. So, I mean, let's just quickly watch it. Let's see what they bring here. So obviously it looks very attractive from the outside. Ground floor at 8.8. So immediately as I'm looking at these kind of things, I'm thinking they're not going to take low offers. They're not motivated to sell, So I'm going to have to buy at full asking price or very close to it to be able to participate. I'm also seeing a pool, security guard, security fencing, lots of levies. Guys, the levies are going to be huge on this thing. Look, it looks very nice. I would maybe consider living here. If I was really interested in living here, I might buy because I want to live there. But from an investment perspective, the cash flow is going to be quite negative. Looks like the phase 1 has been completed, and there's definitely phase 2 happening. Okay, so you might be, one of the first people to get involved in the first phase, or in the second phase, sorry. Okay, it's not too cheesy. Usually it's a lot more cheesier. Okay, location, Benoni. Lightstone property report. I don't know if I trust that. Let's see any numbers. Okay, we can probably work out the... here we go. Okay, so the ground floor is 8.8. 7.5 for that. How much is the levies? Well, if we wanted to work out the calculation here, your bond repayments on 880 is probably going to be about like 7,000, I would say. Your levies will be about 600, your rates 400, and then you want to put another managing agent in place, so 720 for managing agent per month. And you might, depending if you need to pay for electricity or water, let's just say that's all included. You're walking away with a negative cash flow, so you're losing 1,470 Rand per month. Maybe the appreciation's worth it. I don't know. The rental assist will help with year 1, definitely, but it won't help with year 2, 3, 4. And your levies free for 12 months also only helps for the first year. So I would say it's better than the previous that Cape Town deal that iGrow's positioning, but I still wouldn't call this, really a cash flow investment. This is, you're hoping that the capital appreciation will take this deal across the line. Anyway, keep on this channel. Please subscribe, like, send the notifications so that you kept up to date whenever we release a new video. And if you don't mind sharing this with friends, family, or anyone who's interested in property but doesn't want to make a mistake by buying the wrong investment. Chat soon.